It looks like the Federal Reserve Bank is starting to get a little worried about the economy because they just issued a not so subtle warning. Jerome Powell, who is the chairman at the Fed, just gave an interview at the New York Times where he said that the United States economy is growing, quote, unsustainably. Why? Because our economy, our GDP, isn't keeping up with our debt levels. Here's what he said, quote, the US federal budget is on an unsustainable path. The debt is not at an unsustainable level, but the path is unsustainable. And we know that we, the Federal Reserve Bank, have to change that. Why did he say this? Because the United States national debt just passed $36 trillion for the first time ever, which means that the United States government keeps spending money that they don't have. And they're spending this money, hopefully, to stimulate the economy. But Jerome Powell is saying that it's stimulating our debt levels, creating a big bubble, while not stimulating the economy enough. Now, this comes at an interesting time because the stock market is breaking new record highs. The S&P 500 just broke at another record high, and we just got a brand new job market report which said that the job market is still essentially as strong as ever. It said that our job market in the United States added more jobs than expected, so a lot of economists were very happy about this job market report, although if you ask a lot of people in the streets, they'll tell you that the job market is not that good. But focusing on the data, this is where Jerome Powell is saying you're missing something. Although the job market data is good, he's saying it's not good enough because we have this very large national deficit, meaning the United States government is spending a lot of money that they don't have, which should be stimulating the economy even more, but it's not. In 2024, we are going to have the third largest national deficit in the history of time. That means the United States government is going to spend a lot of money that they don't have. They're going to spend a lot of money that they did not generate from taxes. This is money that the Federal Reserve Bank has to print and then lend to the United States government. And if the government is spending all this money on, we'll call it construction and infrastructure and the military and healthcare, this should be creating more jobs. But it's not creating enough according to the Federal Reserve Bank. And this is where he says that we have to start changing things. Now, what is he going to change? Maybe interest rates, maybe monetary policy, we have to see. But this is where Jerome Powell and the Federal Reserve Bank are kind of hinting that we have some issues in the economy and our debt levels that a lot of people are completely overlooking. Now, we've been covering this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy and the stock market and the housing market and the crypto market and the global economy into a fun and witty and easy to read newsletter. It is completely free. We have hundreds of thousands of investors that are reading Market Briefs every morning. If you have not started reading Market Briefs yet, well, I got the link for you down in the description below. That way you can start reading. But this is where Jerome Powell is saying, we don't need to pay down the debt. That's not the concern. It's something else. He said, quote, we don't need to pay the debt down, which is interesting. He said, we don't need to balance the budget, which is interesting. He said, we need to get the economy to grow faster than the debt. And that's not happening, which of course is an interesting thing to say. Now, a lot of people have been talking about how the United States government will never pay back the $36 trillion worth of national debt, how the United States government wants to create more inflation to make that debt less painful to pay back. And this is where Jerome Powell essentially confirmed all that. He said, we don't need to pay the debt down, and we don't even need to balance the budget. We need the economy to grow faster than the debt. Now, how do you get the economy to grow? And this is where there's a lot of opinions on how do you get the economy to grow. Right now, the government has been hoping that you can get the economy to grow by spending more government dollars, not just through taxes, but through Federal Reserve Bank money printing and spending that money, but that's clearly not working. And so if you want the economy to grow faster than the debt, how do you do that? Do you get out of the way and let entrepreneurs do their thing? Or do you do something else? Well, only time will tell. But this is where a lot of analysts are saying, maybe this means that we're going to see less interest rate cuts come in 2025, which of course is very interesting as well, because President-elect Trump is going to be entering the White House in January. And he has been very adamant on wanting lower interest rates. Now, of course, the White House doesn't set interest rates. It's the Federal Reserve Bank. And the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're technically not federal. It says so on their website. They're not a reserve because they're not sitting on cash reserves, and they're not a bank because you and I can't go there to deposit money. But they do have the ability to set interest rates, and they're not supposed to be influenced by who's in the White House. And so this is where Jerome Powell is kind of hinting that maybe we won't be cutting interest rates as aggressively next year. But President-elect Trump wants more aggressive interest rate cuts. And this is where we start to see a lot of back and forth between the Fed, because the Federal Reserve Bank is also going to be meeting very soon, this month in December. And they've essentially confirmed that they're going to be cutting interest rates again. Of course, we don't know what they're going to do until they actually do it, but most of Wall Street is assuming and pricing in that the Federal Reserve Bank is going to cut interest rates in December. So we don't know what they're going to do about that. But this is where Jerome Powell is saying we need to make a change. Here's what he said in the interview as well that you might find interesting. Quote, "We are running," this is the United States government, "very large budget deficits at a time of full employment and strong growth. So we need to address that, and we've got to do it sooner or later, and sooner is better than later." What does that mean? We have this government spending that's happening, which is this national deficit. Remember, 2024 is the third largest national deficit in the history of American history. And this is coming at a time of strong employment. The job market is still strong, and the economy is still strong. So why is the government spending so much money? This is something that we've been talking about a lot on this channel, because normally the government would do some sort of stimulus or spending measure as a way to stimulate the economy. When 2020 happened, the government passed these trillion-dollar spending bills to stimulate the economy, to get the economy moving out of this pandemic recession that we saw, which is why many people never really even saw a real recession, because there was so much money being printed in 2020. In 2008, the government spent a lot of money to stimulate out of the 2008 crisis. During the 2000 and 2001 dot-com bubble recession, the government was spending money to stimulate the economy. But in 2024, we keep hearing and talking about how the United States economy is one of the strongest economies ever. The stock market is breaking new record highs. I mean, the stock market is up more than 30% year to date. So the stock market is booming, housing prices are booming, the economy is booming, the job market is still very good according to the data. I mean, 4.2% unemployment historically is some of the lowest unemployment that we have seen over the last 5 decades. So if the economy is so strong like the data says, why is the government stimulating the economy so much? And this is the problem, because our economy, which is measured through GDP, is a measure of all spending that happens in the economy. Now, there's 3 types of things that influence the GDP. Number 1, this is the spending you do out of your money, so the money that's in your bank account. Number 2, it's the spending that happens off of credit. And number 3, it's the government. Because when you go to Chipotle and you buy that extra guac on your Visa, Chipotle doesn't care if you're spending money that's in your bank account or if you're financing that guac. They just care that you swipe your credit card. Both of those things, your money and your credit, influence the economy, which influences the GDP. But the largest spender in our economy is, of course, the government, which is also a part of the GDP. Many people don't know that, but government spending is a part of our GDP and is included in the measures of our economic growth. So when we take a look at our economic growth, and the data says that our economy is still growing very fast. That's what the data says. Well, the largest spender in our economy is the government. And the government is not spending this money through the tax dollars that they have collected. They're spending this money through the national deficit, through the deficit spending, meaning through the money printing that the Federal Reserve Bank is doing. So the government is spending all this money that they don't have, which is contributing to this growing economy. But this money spending is coming from the Federal Reserve Bank creating this money out of thin air through the money printing. And this is where what Jerome Powell is saying is the problem here isn't that we have a lot of debt. It isn't that we don't have a balanced budget. It isn't that we should pay off this debt. It's that we're printing all this money, spending all this money during a time that the economy is booming. But the economy should actually be booming more than what it is now because of all the spending that we're seeing happen. And it's not booming enough. And maybe this is a problem. This is what he's saying is unsustainable. And this is where you have to start to wonder, what does this mean for what's going to be coming in 2025? Because, of course, President-elect Trump wants to see the economy grow even faster. He wants to see lower interest rates. Will that include less government spending? And how? Now, of course, there's been a lot of talk of DOGE to reduce government spending, to reduce government waste. But the real question now is what's going to happen to our debt levels, and will our economy start to grow faster than our debt levels? Because if the government starts to spend less money, that will have an impact in the economy as well. And the question is, what is the impact going to be? Because government spending does boost the economy in the short term. Because if the government is going out and investing in construction, they're investing in the military, they're investing in anything, somebody's getting paid. When the government goes out and they invest in construction workers are getting a job, construction companies are getting contracts. When they're investing in the military, the defense companies are getting paid to build artillery and machinery. And so if government spending does go down, some companies are going to get hurt. Some people are going to lose an income. How is that going to affect the economy? Is that going to help the economy regulate itself, or are we going to see a bigger problem? And that's what's interesting about this, because we don't know. Everybody has an opinion. I'm just a random guy on YouTube, okay? I know I've said this many times, but I'm a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure always your own due diligence and never blindly trust a random guy on YouTube. But this is where everybody has an opinion as to what's going to happen next year. But this is where I want you to be financially smart, and I want you to be financially savvy, because there's a lot of emotion. There's a lot of emotion that believe that the markets are going to keep rallying, stocks are going to keep rallying, housing is going to keep rallying, crypto is going to keep booming. And then you have a lot of emotion of people saying stocks are going to crash, housing is going to crash, crypto is going to crash. At the end of the day, your job is not to predict what's going to happen in 2025. Your job is not going to predict what's going to happen in 2026. Your job is to figure out how you can build wealth no matter what's happening. That's how you actually win. And the way that you do that is by, number one, being smart with the money that you earn. Stop spending all of your money. It is nuts to hear and read these spending reports. We read them all day, every day, because that's what my team covers and briefs media. We are studying what's happening in the economic news, and we are seeing savings rates fall, spending rates rise, credit card debt levels rise, buy now, pay later rates rise. So Americans are now saying, you know what, I can't afford all this holiday spending, but I'm going to do it anyways, and then I'm going to finance my groceries on my buy now, pay later. It's crazy, but this is what's happening. And at the same time, they're driving around in an $850 a month car. It makes no sense. But this is what's happening. It's good for the economy. It's good for the stock market. It's very bad for you, if that's what you're doing. But if we start to see any sort of shift, the question is, what will happen next? And that's why I want you to be financially savvy. So number one, stop spending all of your money. Then when you don't spend all of your money, save some money for an emergency. That way you have cash to fall back on. In case you lose your job, in case you get sick, in case your kid gets sick, in case anything happens, you have some cash to fall back on. Then start investing your money. Then start to put money aside to invest in case you see a good opportunity. Because we know recessions happen. Recessions have happened in the past. We've seen a recession pretty much every decade for the last century. In fact, we've seen about 16 recessions over the last 100 years, which means we're averaging more than one recession per decade. And these recessions then create panic, they create people freaking out, they create worry, but also they create investment opportunities. But the only people that can invest during these opportunities are the ones that are not blindsided, because you have a lot of people today, I see this all the time, of people who believe nothing bad can ever happen. Well, here's a news flash. Something bad will happen. When? I have no idea. I don't know if it's next year or 10 years from now, but eventually something bad will happen. And you want to be prepared for that. And by prepared, I mean having savings to protect you. And number two, having money to be able to capitalize on investment opportunities. Because when people were freaking out during 2020, when the pandemic was happening, the people that were sitting on cash were buying stocks for pennies on the dollar. And you want to be the one that can find the opportunity instead of being the one that is panicking and freaking out. But in order for you to do that, you got to stop spending all of your money. And I get it. It is hard during a time where inflation is high. It is hard during a time where income has not kept up with inflation, but it's not going to get easier. And that's why I want you to understand this, because you got to figure out how you're going to do it. Maybe you got to work to earn some more money. Maybe you got to cut back on some expenses. Maybe you do both, but you got to not spend all of your money, have some money to invest, and then learn about investing. There are a lot of free resources out there. I have a ton of free resources on my channel. Market Briefs is a free newsletter where we break down what's happening in the markets. And then if you start to make some more money and you have some extra cash, start investing into learning how to manage your money, into learning how to invest. Start by reading books. I don't have any books, but you can start reading books out there. There's a lot of great books on how to start investing. Maybe you start taking more classes, or you start doing some more education on how to learn how to invest. Find what's right for you. If you don't like my channel, that's fine. You can go watch somebody else. I just want to see you succeed. I don't make these videos to make friends. I make these videos to help you be better with money. So learn the game. Money is a game, and unfortunately, most people have no idea how it works. They get caught up in the emotion, and then when things go down, they get blindsided, and then they hate the system. They hate everything, and they blame every single person around them. But this is where I want you to start understanding that you are in charge, and there's a lot of dumb decisions that are happening, and nobody knows when things will take a turn, but eventually they will. And there are concerns in the economy. I mean, the national debt levels is a concern. I mean, the United States government is spending more taxes on their interest on their debt than they are on the military. That's a problem. But most people don't care, and a lot of people don't know that. Who knows how long we can kick the can down the road? But this is where, again, understand what's happening. That way you can find the opportunities, because at the end of the day, markets are going to do this, right? This has always happened. It is not something that's new. There's always issues. For the last 100 years, you can look at any year in the economy and there's always issues. That's not new today. The issues that are here today are different than what they were 25 years ago, but having issues is not new. And this is where you want to be prepared for anything. That way you can build wealth, because our economy is designed to benefit investors. It's not designed to benefit employees. It is designed to benefit investors. Even the tax code. As a licensed attorney who's not your attorney, what I can tell you is our tax code gives preferential treatment to investors, not employees. If we take a look at incomes over the last 5 years, incomes have risen by less than 20%. The stock market has risen by around 90%. If we took at the last 5 decades, between 1971 to 2021, incomes have risen by around 600%, but the stock market has risen by around 4,000%. Our economic system is designed to benefit investors. We're never taught to invest, but that's the game. And if you want to learn how to win in this game, you have to become an investor, and you have to be able to manage the psychology of your investments, because there's a lot of emotion. You see emotion when markets are going up, and you see emotion when markets are going down. And right now we're seeing the emotion as markets go up. Yes, markets can go up a whole lot higher, but markets could also fall. And you want to know, how do you win when markets go up and when they go down? That's where the real wealth is built. But unfortunately, most people don't care about that. People think that they're geniuses when markets are going up, and they think nothing bad can ever happen, but you want to be prepared no matter what. That way you can capitalize on opportunities when markets are up and when they're down. And it starts by understanding what's happening and investing in your own financial education. And that's the end of my YouTube rant for today. If you haven't joined Market Briefs yet, make sure you join. And with that, I will see you on YouTube tomorrow. And did you see the Lions beat the Green Bay Packers? Let's go, baby. All right, I'll see you on YouTube on Monday.